Jack Bogle addressed, "Beware of this one mistake 99.99% of investors make." Even the most successful investors make money mistakes, including Vanguard founder Jack Bogle. His worst bet, he says, was merging the mutual fund company he was running in the 1960s and early 70s, Wellington Management Co., with a go-go fund management group. It cost him $1 billion in assets and his job. Today we're going to talk all about what Jack Bogle addressed about the investing mistakes. So watch this video till the end, because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. Bogle was hired by Wellington Management, which did the investing for the conservative Wellington Fund, straight out of college in 1951. He worked his way up to executive vice president by 1965. Shortly after, hoping to keep his fund alive during the go-go era, he initiated a merger in 1966 with investment counseling firm Thorndike, Doran, Payne & Lewis. The small Boston firm was owned by 4 young partners and managed the Hot iVest Fund, a $30 million aggressive mutual fund, among others. Bogle became CEO of the merged company, and for a while, the union was a success. But when the market collapsed in the early 70s, so did the company's prospects. Assets of our flagship, the conservative Wellington Fund, had tumbled from a high of $2 billion in 1965 to less than $1 billion, on the way to a low of $480 million. Bogle writes in his 2018 book, Stay the Course. The earnings of Wellington Management Company plummeted, and its stock price followed suit, dropping from a high of $50 per share in 1968 to a low of $4.25 in 1975. In 1974, the Wellington board fired Bogle as CEO. It was the most heartbreaking moment, actually until then the only heartbreaking moment of my entire career, he writes. Bogle's mistake convinced him that rather than trying to actively beat the market, he should create a passively managed fund that tracked the market. And ultimately that led to his crowning achievement, launching the Vanguard Group and creating the world's first index mutual fund. As he writes in Stay the Course, Vanguard was conceived in hell and born in strife. Its creation was the result of an unsatisfactory compromise that ended an ugly fight for control of Wellington Management Company, a fight that cost me my job as CEO and made it appear for a time that my career in the industry I loved was over. Today, Vanguard, the world's largest mutual fund company, manages $5 trillion in assets, and Bogle has done well for himself too. Now 89, his estimated net worth is somewhere in the low 8 figures. The Vanguard group of investment companies, which grew to have $4.9 trillion under management, was built on a belief that, over the long term, most investment managers cannot outperform the broad stock market averages. Jack Bogle made an impact on not only the entire investment industry, but more importantly on the lives of countless individuals saving for their futures or their children's futures. Tim Buckley, Vanguard's chief executive, said in a statement. Here are some of Mr. Bogle's investment tips. Number 1. Stay the course. Wise investors don't try to outsmart the market, he says. They'll buy index funds for the long term, and they'll diversify. Long-term investors must hold stocks even though the market is risky, because they're still likely to produce better returns than the alternatives, Mr. Bogle said in 2012. Investors should weather any storms, he told the Wall Street Journal in 2016. If we're going to have lower returns, well, the worst thing you can do is reach for more yield. You just have to save more. Number 2, beware the experts. Money managers missed all the warning signs before the 2008 financial crisis, Mr. Bogle noted. How could so many highly skilled, highly paid securities analysts and researchers have failed to question the toxic-filled, leveraged balance sheets of Citigroup and other leading banks and investment banks? In 2017, he waved younger investors away from financial advisors and gave his approval to robo-advisors. Unless you need a financial advisor to help you get started in that routine, you probably don't need a financial advisor at all, he told CNBC. Number 3, keep costs down. Vanguard's fund shareholders own it collectively, so there's no parent company or private owner to siphon profit, allowing the firm to keep costs down. In investing, you get what you don't pay for. Costs matter, so intelligent investors will use low-cost index funds to build a diversified portfolio of stocks and bonds, and they will stay the course, and they won't be foolish enough to think that they can consistently outsmart the market. Mr. Bogle became a harsh critic in his later years of the mutual fund industry and the high fees charged to investors for stock picking expertise. Number 4. Don't get emotional. Invest in a diverse selection of stocks and bonds. Trust in the arithmetic and stick to it. This was the essence of Mr. Bogle's advice for Vanguard investors. Impulse is your enemy was one of the mantras. Eliminate emotion from your investment program. Have rational expectations for future returns and avoid changing those expectations in response to the ephemeral noise coming from Wall Street. Number 5. Own the entire stock market. Mr. Bogle was the leading proponent of structuring an investment portfolio to mirror the performance of a market yardstick, like the S&P 500 stock index. The S&P 500 is a great proxy, Mr. Bogle told the Wall Street Journal last year, adding that he hadn't bought an individual stock in about 25 years. Mr. Bogle also told CNBC that the United States market was a safer bet than other markets. U.S. companies are innovative and entrepreneurial, he said. Mr. Bogle, Jack as I always call him, was the apostle of low-cost, diversified stock and bond mutual fund investing, mainly through index funds, which he invented in their first commercially viable form. Such funds are inherently cheap to run, he said, because they merely mirror the market and keep trading costs to a minimum. They can't beat the best performing stocks and bonds over the course of 1 year, he said, but they will prevail over the long haul for investors who can avoid the kind of short-term thinking that Wall Street's annual investment cycle promotes. Why is a year merely a blip in time from an investing standpoint? He explained why in the Arithmetic of All-In Investment Expenses, a carefully researched 2014 article in the Financial Analyst's Journal. The article pointed out the peril inherent in Wall Street marketing, including annual forecasts that focuses attention on short-term returns. Unless you think over longer time spans, you may not appreciate the harm being inflicted by excessive investment fees. A seemingly small annual difference of 2.2 percentage points in costs can cut roughly 40% of your retirement savings over 40 years, he calculated. That's because the math shows that it's not only profits that compound over time, costs do too. Investors need to watch out for themselves, unfortunately. Mr. Bogle warned that the costs of stock trading and investment fees can easily ruin your prospects for a comfortable retirement. While the past provides no guarantees for the future, it suggests a course of action. Holding stock index funds for their higher returns and bond funds for reliability and for offsetting the ups and downs of the stock portfolio. How much and what kinds of each, the fancy name for this is asset allocation, are critical and individual questions. That's all for today. In the end, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. Well, that's it for today's video, guys, and make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye.